about how we're meeting the boomer buyers' needs with this HECM is probably the acronym you're going to hear, but HECM for purchase. And our guests today are going to be the two Scotts, Chris and Christina. And let me just introduce everybody real quick. So we've got Scott Degnan. He's a realtor, a branch manager, and a partner with My Home Group San Diego. Scott's been in real estate since 2007, and he started selling high-rise condo projects in San Diego. And after really a short amount of time and being really successful in that, the company moved him up to LA, where he managed $1 billion project, $1 billion+ project called Park Fifth. And currently Scott's the branch manager and partner of the San Diego branch of the My Home Group, which, I mean, this is awesome stuff, by the way, which Inc. magazine, the Inc. 500 ranked as the 7th fastest growing real estate company in the nation 3 years in a row. So that's explosive growth year over year. And he's been in mortgage, and he's just a really, really smart guy, and we're lucky to have him. So Scott, thanks for joining us today. Look forward to hearing from you. Scott Owens, the next Scott, is the vice president of Century Residential and Mastercraft Homes, and they focus on residential development of 55+ communities in the Central Florida area. Scott oversees marketing and sales. Obviously, like as we start to think about what we're talking about today, right? HECM, HECM for purchase options. Having somebody here who's managing 55+ communities, I bet that this product makes a ton of sense for Scott Owens. So Scott, glad to have you down there in Winter Haven. So Chris Bruiser is a veteran with HECM for purchase specialist who works with builders and realtors who are looking to capture incremental sales by educating their clients on the H4P program. And he's the #1 producing H4P loan officer in the Southeast, whose main builder partner attributes almost 40% of his total sales to the H4P program. So you guys, you'll hear this from these folks today, but this is stuff that's really impacting their businesses, right? And then Christina, who's actually going to kind of be the MC. I'm going to step out of the way, and Christina's going to kind of lead the group through this really awesome discussion today. But Christina is the assistant manager of C2 Reverse and one of San Diego's leading experts in reverse mortgage. And she's often interviewed you'll see her on the TV and radio and newspapers if you're down there in California and Southern California. She's an assistant manager for the reverse division, but she also originates these mortgages as well, alongside her pops, Scott Harms. And she describes her work, and she'll probably talk about this today, but as one of the most rewarding parts of her job is being able to use these types of products to help people, in the later years in their life. And so I'm super excited to have all of you guys. Christina, I'm going to bring you on, and we'll kind of get a chance to hear from everybody else. I guess I'll give you just one quick, how you guys all doing today? That's always an awkward deal, right? Because nobody wants to say I'm doing great. Nobody wants to talk over the other person.
Buddy, I'm in San Diego. It can't get any better than that.
Oh, man. You know what? Of all the places in the United States that I've traveled and been and stayed, San Diego's amazing, right? It's always 80 degrees there, maybe 75 to 85. It's what a great area of the country. But all right, so Christina Harms, I'm going to bring you on. How are you today?
Good morning. I'm doing great. I'm really excited to bring the word to all these realtors about what an amazing program we've got for you today.
Awesome. Well, I'm going to step out of your guys' way, and Christina, I'm going to let you take it over, and I'll be here. I might pop in with a question or something, and definitely at the end, but you guys take it away. I'm looking forward to actually being educated myself. So.
Awesome. Thanks so much, Bob. All right. Welcome to the webinar, everyone. I am Christina Harms, and we are here to talk to you today about a huge opportunity. We're going to make home buying more affordable for the senior population. And I'm sure you've got lots of clients that are 62 and older because, believe it or not, 25% of home buyers are 60 years or older. So the opportunity here is huge. I know a lot of you are hearing all over the place, oh, millennials, millennials, millennials. And while that's true, millennials are a big part of the population, making up a lot of home buyers. But don't forget about the boomers. Boomers make up 75 million people in America, and 80% of them are already homeowners. That's where your listings are going to come from. The millennials are great. They're new home buyers for the first time, so you're going to get that purchase. But with the boomers, you're not only going to get the purchase, you're going to get the sale of their current home. So please do not discount the boomers. We're here to bring you some opportunities today. So we're going to go over some scenarios about how you can serve the boomer market. And after this call, I think you're going to want to go back to some of your old files because this is going to open up some opportunities where there weren't any before. So the H for P is the HECM for purchase. We're going to use that word a lot, HECM. That's home equity conversion mortgage. And I'd like to hand it off to Scott Degnan, actually, because while we are all mortgage professionals and we're going to be talking about the product, we wanted to bring in a realtor who could really tell you why it's so exciting to have this product in his portfolio to serve his clients. Scott, are you there?
I am. Thank you, Christina. Yeah, starting out in the mortgage business back in '98 and then transferring over into real estate, it kind of gives me that perspective of how to structure deals. And I think by having this HECM, that you can use this as an alternative to give your clients options. As a lender turned realtor, I came from a background of working with a lot of different mortgage financing tools, but I know that using the reverse mortgage to buy a home seems a little counterintuitive. What I can't tell you about the HECM for purchase is how it's different than a typical reverse mortgage. I think that given this opportunity to your clients, it allows you to not only sell more homes, but maybe put them in a better situation for later down the road for retirement. And I think that if anybody can explain this, it would probably be Chris Bruiser that can go into that and help us understand a little bit more about that.
Thank you very much, Scott. And for what it's worth, I'm talking to you from sunny Tampa, Florida, where we have a lot of baby boomers, retirees, people just like my own parents, Steve and Connie Bruiser, who are up in Cincinnati, Ohio. But before we get into any more of the opportunity, let's talk about what this thing is. What is the HECM for purchase? And so we're going to give you some basics and we'll proceed from there. First of all, HECM stands for Home Equity Conversion Mortgage, or H for P for short. This program is no longer new, although many people are continuing to just learn about it. The program actually was introduced in 2009, and this program is designed specifically for people who are 62 and older. 62 and older. The whole point of the HECM program, one of the main points, is that it can dramatically increase your buyer's purchasing power. Next slide, please. Before I get onto this slide, I do want to make sure we have a clear distinction between some of the vernacular we're using today. You have heard a few times already about the word reverse mortgage. And although this program does have characteristics of a reverse mortgage, it is distinctly different. And I'd like to give you just a quick explanation of the distinction between the two. A reverse mortgage, there actually is a home equity conversion mortgage, but that is for people who want to stay in their existing home and they have built up equity over the years and they would now like to stay in their existing home, but they would like to be able to use that equity to be able to improve their current financial and overall quality of life. The primary benefit of taking out a home equity conversion mortgage on a home in which you already own and live in is that you can have access to that equity that you worked hard to put into that home over those years, but you're not required to make a monthly payment back. And so the HECM for purchase is similar, but this is used for someone who is selling their existing home and they are going to go out and buy their next home and they're going to use the HECM for purchase to make that possible. So just want to make sure we're clear, and I hope that that is clear for everyone, the distinction between a conventional or traditional reverse mortgage and the HECM for purchase. So what it is, it requires a home buyer 62 and over. They're going to be making a one-time cash payment on the purchase price of the new home. As you can see from our matrix here, that based on their age and the purchase price really determines their required down payment. And one of the things that you'll probably notice is that the older a person is, the less equity they have to put down on the purchase price of that new home. The remaining amount is financed with the home equity conversion mortgage. And again, similar to its sister product, there are never any required monthly mortgage payments that are required to be made for as long as at least one homeowner lives in that home. So again, they're going to put down a one-time down payment, somewhere between 50 to 60%, and they have no more payments. The loan does become due when the last eligible spouse or borrower permanently leaves the home, either by moving, selling, passing away, or failing to meet the obligations of the loan. Next slide, please. So just a quick step back, why is HECM important? Well, previous to 2009, your boomer buyers only had two options of how to purchase their next home. In retirement, most boomers would prefer to not make monthly mortgage payments in their retirement years. And so if you don't want to take on monthly mortgage payments, then the only way to purchase a home would be to pay 100% cash for the full purchase price of that home. And yes, you don't have any more payments, but you now have tied up 100% of the equity that you had to be able to purchase that home. Next slide, please. Well, thanks to HUD and FHA, since 2009, your boomer buyers who are 62 and over now have a third option. And this option they're going to want to know about, because the HECM for purchase allows them to pay a fraction of the full purchase price of that home. They still own the home. They are on title of that property, but they are making no monthly mortgage payments. They maintain all the rights and privileges of homeownership and those responsibilities, but because they're not using 100% of their cash, and also because they're not making a monthly payment, they are able to preserve capital at a very important time of life when liquidity is very important. Next slide, please. So how does one qualify? Well, we've mentioned this. We say 62 or older, but I like to use the word 62 or better. At least one spouse must be 62 or better. This is for the purchase of a primary residence only, and the down payment funds must come from their own assets, although gift funds are allowed, but they're not allowed to borrow any of the money. Also, what makes the HECM different than a conventional mortgage is that there are minimal income qualifications. We do document their income because we want to make sure they can afford their property taxes, their homeowner's insurance, any HOA fees, and they must be able to maintain the property. Next slide, please. This program is regulated by HUD and it's insured by FHA. So just like with a conventional FHA loan, the property types that can be used to purchase a home are very similar. Single family residences, planned unit developments are okay. FHA approved condominiums. And although there is no maximum or minimum purchase price, the HECM will be based on, at the highest amount, the first $679,650. So theoretically, a person could buy $1 million home, but we're only going to base the HECM on the first $679,650 of value. Next slide, please. So what are the borrower's responsibilities? Well, they're going to be pretty similar to the rules that they would have to abide by in any other circumstance. Because they own the home, they are responsible for paying the real estate taxes, the homeowner's insurance. They're required to take care of the property, maintain it. They also are required to pay any association fees or HOA dues that might be applicable. And once again, they have to live in the home as their primary residence. Next slide, please. So this is very important for real estate professionals to understand. These are just a few tips to remember. The funds, again, must come from the borrower's resources. They can come from investment accounts. The equity could be coming from the sale of their existing home. But we do document where that money is coming from. They cannot be borrowed. The contracts should be hopefully clean as a whistle, which means there's no seller concessions, although the customary seller pays are allowed, and that does include home warranties. The condos must either be on the FHA approved list or they must be approvable. And although this was never meant to be a construction loan, it does work for new construction. We have some new guidelines that were put in place recently, whereby now we can take the application before the certificate of occupancy. We used to have to wait for a little while. And although we can take the application, we still must wait for the CO before we can order the appraisal. Next slide, please. I'm going to pass it over in just a minute back to Christine, but one thing I did notice that's very important for my real estate professionals is that the HECM for purchase is also not subject to TRID guidelines. So I know that's a big breath of fresh air for a lot of people on this call. I thought about that about an hour ago, but thank you, folks. I hope that was a good introduction to the basics of the program, and I'm going to pass it back to Christine.
Thank you, Chris. That was a great overview, real detailed. Okay, everyone, I want you to think of the last listing presentation you had. And it didn't turn into a listing because when you got to the net proceeds, it just wasn't enough for them to do what they wanted to do with it. Now, if those buyers were 62, after this call, you might want to go back to them, because one of the things that is really great about this program is you can take someone who didn't think that they had enough equity to sell and buy again. Maybe they wanted to buy in all cash because they don't want to have a mortgage payment in their retirement years. You can come to them with this H4P program and suddenly they can buy again. I want to go over one scenario that is a true scenario. Of course, we changed the names and rounded off the values a little bit. But this is a true scenario here in San Diego. So Jim and Sally were, Jim was 63, Sally was 59, and Jim had been diagnosed with a heart condition. Well, they'd been living in their home for about 20 years. It was the home that they raised their kids in, and the bedrooms were all upstairs. So Jim couldn't walk up and down those stairs anymore. His heart condition was very fragile, so they ended up looking into selling their home, but they weren't going to be able to get enough out to go buy again, especially the same kind of house they were in. They didn't really want to downsize. They didn't want to upsize. They wanted the same size, but they needed to have a single story instead of a two-story. Luckily, their realtor knew me and said, "Hey, can you go and talk to them? I think that they might be able to do something. I'm not really sure, but they've got a lot of equity, just not enough to go buy again." So what did we do? We pre-approved them, and again, with the H4P, the income and credit requirements are a little less stringent. So while they couldn't qualify for that forward to buy again, they were able to qualify for the H4P. They're still credit qualifying, but it's just a little less stringent. So what did we do? We sold their two-story home for $640. Again, I'm in San Diego, so inflated prices out here. We paid off their mortgage of $200,000. It cost about $40,000 to do the sale, and they walked away with $400,000. Now, $400,000 walking away sounds really great in some markets. Next slide, please. So this is the home they were leaving. Beautiful two-story, three-car garage, beautiful, beautiful home in the outskirts of San Diego. But $400,000 wouldn't buy this home again. Jenny, if you could next slide, I think we'll see a home. Oh, this is the home they wanted to buy. So again, this one is very similar. Same quality construction. It wasn't too far away. Single story. Still have a lot of garages they needed for all their tools and toys, but it wasn't a downsize. In San Diego, a $400,000 cash purchase, so they wouldn't have any ongoing mortgage payments, would look a little more like this next slide. Oh, you know what? It must have been taken out. Okay, so let's get into the weeds of it. So we could upsize or downsize. Here in San Diego, they same sized. So we had cash after sale of $400,000. The new home cost about $600,000, so it was a little bit less than what they sold for. The HECM proceeds provided $298,000. So they needed to bring in $319 of their $400,000. They had proceeds, and they actually got to keep $80,000 afterwards. So not only were we able to get them into that single-story home that met their lifestyle needs, their medical requirements, they were really happy, and they had an extra $80,000 to put into their retirement account. They were very, very excited after being able to do this, especially when they thought if they didn't want to have a mortgage payment, there was no other way than to buy in cash. We were able to close on this. This was about a year ago, and he is doing great with his heart condition. Okay, so that should open up a lot of ideas for you guys to go back to some people that didn't quite have enough equity to sell and do what they wanted to, who are over 62. We've got some more scenarios for you. So for the next scenario, I'm going to hand you back to Chris Buser. If you could, Chris, are you there?
I am. Thank you, Christina. That was great. There's a lot of scenarios, but that's definitely a very common one for sure. So this is interesting. So it also brings up a whole bunch of other buying options and decisions. One of those happens to be, well, wow, now, Chris, because of this program, people ask a lot of times, well, Chris, does it have to be a brand new home? Well, my comment to them is that it has to be new to you. So you can use this for a resale property purchase or a new construction. So allowing somebody who did not think that they could afford a brand new construction home and design that home exactly the way they want it, that opens up a whole bunch of new opportunities as well. And so as we discussed, we have Scott Owens on the call with us today. And Scott is a builder and developer out in Central Florida, about an hour away from me. And I'm going to have Scott present some topics to you from the builder's perspective and what it's done for their business. Scott, are you there? Scott Owens.
Yes, Chris, I am. Thank you. And Chris, you know, we've been using the home equity conversion mortgage program for several years now. And it most certainly has proven to be very successful for us. You know, to our real estate professionals that are listening and watching again, I can share with them as a residential developer and builder, particularly of new homes, the home equity conversion mortgage program provides a unique opportunity for people to have actually more buying power and purchase the home they would really like to have. And this program also actually affords them the opportunity, especially in the new construction process, to select more upgrades for their new construction dream home. I'll also share with our realtor community and for their clients, the home equity conversion mortgage purchase becomes obviously a very valuable financial tool as well. You know, Chris, thinking about here at Lake Ashton in our 55 and better community here in Central Florida, our customer, I'm thinking back on our customer, the Scheibels, they had purchased not long ago, and the Scheibels had an overall financial plan for their retirement, as many people do. And the home equity conversion mortgage program afforded them the opportunity to contract a new construction home with the one-time down payment and include the upgrades they have always wanted to do while staying within their overall financial plan for their retirement, which is extremely important. You know, when your customers are able to get what they want and in addition stay within their financial plan, you know what? You have a happy customer. And Chris, I'll tell you, and important to us all is that when we know we have happy customers, we also have a wonderful referral source as well. So here in our community and in our communities, most certainly we love the program. It's worked very well.
Well, thank you, Scott. I think it's important for you know, people to hear it from a, you know, your perspective versus just one perspective, but thinking about that particular customer, he had plenty of cash to buy the home and pay 100% cash. But
Correct.
when he was presented with this option, it changed that landscape for him, and it allowed him to make different strategic choices with his money as opposed to having it tied up in that home. So what we find, Scott, and tell me if I'm wrong here, that that is a very common theme, that people do have the cash to pay for the home, but when they find out about the HECM, it opens up different opportunities. Would that be a fair assessment?
Oh yeah, without any doubt. And options are wonderful because they can choose what's best for them, and in that case, that worked very, very well for them.
Sure. And then thank you, Scott. I mean, that's very valuable, and it really is a game changer for those folks. And then, Scott, let's talk real quickly also about the people that might come into your sales center and maybe sheepishly, they maybe simply just don't have the 100% cash to be able to afford to buy in your community. And talk about maybe the ability for you to capture those lost opportunities from people that might walk out the door, but now, because of the HECM, they actually can find out that they can purchase in your community. Has that been a benefit to you as a builder from your sales efforts?
Yeah, most certainly. That's opened up another avenue as well. And again, they may find that that they obviously would have that one-time down payment, and most certainly that helps to open up a whole new category for them, and also opens up a new category regarding the level of home that they can purchase as well. So most certainly, Chris, that's a huge advantage for them to have that opportunity available to them as well. So that does change the landscape on that end as well too.
Beautiful. So, folks, thank you very much for listening for that to that aspect of this program. We talked about the ability for people to create their own financial strategy because of the ability to preserve capital, and their financial planners are very interested in that conversation as well. And so just know that I am going to turn it over back to Scott Degnan, because Scott has seen some different opportunities from the real estate professional side. So Scott, can I turn it back over to you, please? Scott Degnan.
Sounds great. Thank you, guys. From a realtor perspective, I look at it as, there's other opportunities that you have besides just having one property being sold. So you can use that 50 or 60% down, depending on their age, and get them into one property, but take that other half of what they sold their home for and use it to either buy another investment property or give it to a financial planner and let them get some positive cash flow going. So they can, buy the property that they want to live in, put the other half down on an investment property and let it cash flow for them, and have no house payments on there. So the big thing for me as a realtor is creating opportunity to get another deal out of it, as well as another referral source, and as well as taking care of the client. So that's kind of how I see it. But I'd like to pass it back to Chris as well, and get a perspective from more on the loan side of it, and work together between the loan officer, the realtor, and possibly even your financial planner to start sending them business, and in return, they're going to remember you and send you business as well. Chris, are you there?
Yes, I am. Yes, okay. I am. Thank you very much. I wanted to let you finish that thought. Fantastic. So the other scenario that we see a lot is, again, people moving and relocating specifically to Florida. A lot of times this program now affords a lot of more intrinsic benefits to people because of this newfound opportunity. Being able to relocate to be closer to their grandkids, whereby before that might not have been possible. We're talking about having the potential to have generational positive impact because of those relationships that can be nurtured and developed by grandma and grandpa being able to now afford to live closer to the children, whether that be by downsizing to a lesser expensive home, or in the case we saw that Christina showed, the ability to actually upsize if they happen to have to move to San Diego to be near the grandkids, where homes are a lot more expensive out here. But it really creates some unique opportunities. We even have some grandparents who have been able to help pay for their kids' college because of the money that they have not had to tie up in their home. Here's an example right here. We have a customer named Bruce. Bruce wants to see the grandkids more. Lived in a nice suburb in Atlanta, you know, and to be closer to the kids. The purchase price on the new construction home was $235,000. The HECM provided $140,000 of that financing. The sale of the current home, minus the liens, brought him about $170,000. So he's going to use $95,000 from the sale of that home as a down payment. He now has a new home closer to his grandkids, and he was able to add $55,000 back into his retirement accounts, with no monthly principal and interest payments. Again, he is responsible for paying the taxes, insurance, HOA fees, but now he is closer to his grandkids. He has no more monthly payments, and he was able to replenish his retirement account with the leftover funds. So very, very impactful to these people's overall quality of life, not just their financial health. So that's just one more example that we do see a lot. So with no further ado, I'm going to pass it back to Christina.
Thank you, Chris. That was great. Okay, so that was a really kind of heart-touching situation. Unfortunately, what we're seeing is that divorce in what we call silver divorce, later years of life, is on the rise. And in that type of situation, you can come in and be the hero. What will often happen in these silver divorces is they sell the marital home and both go rent. But who wants to rent in retirement? I don't have to tell anybody on this line that renting in retirement is not a good recipe. Rents are rising. Landlords don't have to care if a senior can't make their payment. And on a fixed income, renting is just not a good solution. But with divorce and selling their marital home, what other options do they have? Well, if they know you, now they know they can each go and buy a new home with the proceeds they get. Let me explain that a little further. We've got an example for you here. Jenny, if you could, next slide. Oh, it looks like there might be a little glitch. There we go. Okay, thanks. Okay, so HECM for purchase. Let's go out with two options, because whenever I have a client call, I actually had a client, Mary. She called and she said, you know, I'm thinking I'm going to be divorcing my husband, but I didn't work much. I don't have a retirement income to pull from. I don't know what I'm going to do. And so in that type of situation, we'll lay out, okay, do you want to stay in the home? And that's solution number one. And that's a great solution. One spouse can buy out the other spouse. Or solution number two is, you know, maybe they have a lot of memories in this home and neither of them really want to stay. Let's both get new houses and start over fresh. So let's sell that marital home and let's each take the proceeds we're going to get, split them, and go buy our new homes. A fresh start, but it's owning a home. It's not just a fresh start in a new rental property. And for you as the realtor, you have turned that situation not only into a listing, as with many divorces, you're going to be getting the listing, of course, but you've turned it into two purchases. And because you're the realtor who understands the H4P product, they're going to be going through you for those two purchases. So this is a really interesting way to be able to use it. And you can be their hero, creating a new home ownership opportunity where they didn't think there was any. So let's go a little bit into Mary's situation. So Mary called me and said, hey, I don't know what I want to do. Let's figure out what this is going to look like. So again, I'm here in San Diego. So the estimated proceeds from the sale of their home was $746,000. So there's that listing for you. You're going to sell that, and each spouse would get $373,000. That's option number one. Then go in San Diego, you're not going to be able to buy for that amount. You might be able to get a condo, but again, you're going to have to income qualify. And most people coming from, I think that was a $1.2 million property. They had a mortgage to pay off. So coming from a $1.2 million property going to a $350,000 condo is not the kind of lifestyle situation they want to be in. But we laid out this option. So then option number 2 was either spouse refinance and keep the home. And that's a great option. Some people do want to do that, especially if they're very sentimentally attached to the home. And that's just, again, the normal reverse mortgage. But let's get to option number 3, which is really the exciting one. So option number 3, you list their home. They're each going to walk away with $330,000. So then you can present them, wait, don't just go rent, don't move in with family. You should absolutely still be a homeowner. You don't want to miss out on that opportunity for appreciation. And you want to control the roof over your head. You don't want rents to rise and have a landlord be able to kick you out when you're 80. So let's look at buying again. How can we do that? Let's take $300,000 for a down payment, use the H for P program, finance $200,000 of it, and now we can get to a purchase price of $500,000. And on top of that, you're going to keep $30,000 cash in your pocket, cover things like moving expenses, and hey, put the rest with your financial planner. And $500,000 in San Diego will buy a single family home. That's exciting. You're taking a homeowner. It's not quite the same, but if they move out of the center of the city a little bit, they can get a pretty decent house. So you've just become their hero, and you've become your own hero because you not just got the listing, but you've created 2 buyers out of that as well. So that is one of my favorite because I believe in home ownership, as do you all, and that is the ability to keep home ownership even through a divorce in a situation like that. So I hope this has really opened up some amazing ideas for you guys. And if you have any of these, please mention to your clients. Let's just look at the numbers. So that was my portion of it. I'm going to pass it back to Chris Buser to handle us out. Chris, are you there?
I am here. Sorry, I just had you on mute. So I'm excited to get to the questions and answers, but let's just do a quick summary here for everybody, and then we can move and answer some of the questions that most people are going to have. So once again, why HECM for purchase? First of all, it's a regulated, it's a safe FHA insured loan. While we're on that subject, we forgot to mention something very important. Let me talk about this right now. We're actually going to get there, but the FHA insurance is very important, and we'll talk about that in just a couple more notes. Again, the HECM for purchase enables those 62 or older, I like 62 or better, to purchase at a fraction of the purchase price and possibly upgrade at a fraction of the price. They are making a one-time down payment, but they have no monthly mortgage payments, which allows them to preserve capital and maintain liquidity in their retirement years to help when those unexpected out-of-pocket costs come along, usually healthcare related. This allows people to plan more appropriately for those kinds of things. It's also, we have to call very flexible, because one thing we also did not mention yet is that they are allowed to make payments at any time without a penalty. There is no such thing as a prepayment penalty. So if someone does want to make a payment here and there or make a monthly payment, they will be getting a monthly statement. The only difference is that our statements do not come with a return envelope, but a monthly payment is allowed to be made at any time without a penalty. The other very important detail that is extremely important to this demographic is that the FHA insurance is a little bit different than what you think of in a conventional FHA loan. With a conventional FHA loan, the person is not putting 20% down, so they are required to pay mortgage insurance. Well, there is mortgage insurance with a HECM, but it does something very important. And what that does is the insurance protects not only the homeowner, but it also protects their heirs and beneficiary from ever having any personal liability in the matter, which the legal term is what you see at the bottom. That is called a non-recourse loan. So just know that that provides tremendous peace of mind to the homeowner to know that they can still leave a legacy to their heirs and to their estate. Chances are there still will be equity left in that home, but if we have another housing crisis like we did in the last 10 years, And if at the end, if the value of the HECM ever grows to be greater than the value of the property itself, there is no liability to the heirs or to the estate for any deficiency. So very important. Next slide, please. Okay, and for the real estate professionals, you're on this call for a reason. What can this do to help you? Well, again, you've seen the numbers. This can allow you to sell more homes, make home buying more affordable for your 62 plus buyers, potentially be able to move renters into buyers, but more importantly, meet the needs and be a true resource to your senior clients. Makes you feel good. Next slide, please. Okay, so we've got a bunch of different resources, but Normala has come out with some great consumer guides that are on the website for consumer use, but for the real estate professionals, we invite you to visit normalaonline.org, where we have a toolkit designed specifically for real estate agents, and we also have a separate resource that's used and is developed specifically to the builder community, for home builders, people like Scott out in Central Florida who've already adopted it. So we've got a lot of great resources for you, and we hope that this has been valuable, and we hope that we've taught you something that you were not aware of about 45 minutes ago. So with no further ado, I'm going to turn it back to our facilitator, Mr. Bob.
I did the same thing. I was muted and then frantically trying to unmute myself, pushing the wrong buttons. Wow. So I got a really good education, and there's a bunch of questions here. And so I've been kind of pulling them out and condensing the same question being asked more than once. And I don't necessarily know who to serve these questions up to, so I'm just going to serve them up, and whoever of you guys feels like you're kind of the expert to answer, feel free to jump in. But before I do that, though, thanks. This was really, really informative. Somebody on here had said this is literally the best presentation they've ever heard online. I think it was Jim. So kudos to you guys. Really great stuff. Let me, and a lot of people now checking in and just saying, hey, this was a great presentation, great information. There is a handout. If we went back to the next slide, the link that it sends you to, those two toolkits there, the one for the builders and the one for a tooltip or kit for real estate agents, if you find the handout section on your GoToWebinar control panel, and a couple people found it earlier, you can go in there and actually download those PDFs right from the presentation today. I would still encourage you to probably go over and check out the website and kind of poke around. One of my questions, and I don't know who wants to answer this, somebody had asked earlier, is this available in all 50 states? And so maybe somebody could answer that. And then, like, if I'm wanting to get connected to somebody who kind of knows this stuff, right? And like, if I was in San Diego, that'd be easy enough, right? I could probably talk to Christina. But if I was in like Nebraska or something, how do I go about kind of finding somebody that I can connect with? And I don't know who necessarily wants. Christina, do you want to take that, or?
Sure,
Hey, yeah.
Christina, Christina, go right ahead.
Oh, sure. I'm actually typing in the URL just to make sure I'm going to walk you guys through it. So in any market, yes, of course, all 50 states, and you're going to want to find someone that is going to be able to help you and answer your questions. So you can actually visit that same link, normalaonline.org, and I am on there right now. I've got to play around. Chris, do you know exactly where it is, where you can look up lenders in your local market?
Well, again, if you go to normalaonline.org, you can certainly find a certified reverse mortgage professional through the Normala website. But I believe you can also go right to HUD's website as well. If you go to HUD.gov and you do a search for the HECM program, HECM purchase program, I believe that you can find that information right on HUD's website, if I'm not mistaken. But normalaonline.org is also a great resource.
I don't know if Jonathan I don't know if Jonathan's on your guys' team here, but he is serving up all the links I'm going to share this one that he just gave me. I'll send it out to everybody. And this is the link of where you can actually go to find the certified reverse mortgage professional. So I just sent that out as a link to everybody. Thanks, Jonathan. He's working the website over here and sending in links. Gosh, there are just a lot of questions here. Let's do. Can they maintain a second property? Had a couple people ask that, and they get that the one that they would be doing the purchase on would be their primary, but could they maintain a second property?
Christina, do you want to take that? I'll be happy to.
Sure, I'll never turn it down. You get the next one.
That's okay.
Yes, they can definitely have a second property. The HECM for purchase needs to be on their primary residence where they actually live, but they can't own other properties. They will need to be accounted for in the qualifying as with any other loan.
Okay, cool. Is this something that I can use more than once in my life? I'm assuming I can't have, like, I can't be doing it at more than one time, right? Like, I couldn't have two of these at the same time, or maybe I could.
Correct.
But can I use it again?
No.
Okay, so I can't have more than one at the same time, but if I was to sell that property, I could do it again in the future?
Sure. I've had multiple people have chosen that route where they purchased a home using the HECM. They were able to buy that home at a very good below market price. They were able to put some money into it, and they were able to sell it a few years later, and then they turned around and they did it again on another property. So they were able to use leverage to leverage an already unique situation.
Okay. A couple kind of questions around, like Clayton saying that there's not a balloon or anything. It just it gets kind of settled up when the owner passes away, and you had mentioned one of you Scots had mentioned earlier. I think it was one of you guys. Might have been Chris had mentioned, like, if they, let's say both spouses were to pass away, for example, and there was still equity left, that's going to pass on to the heirs just like it would if they didn't have one of these mortgages, right? Okay.
That's correct. That's correct. So the home still goes to their heirs just like they would under any other circumstance. Obviously, at that time, the heirs have a decision to make. The first question is first of all, do the heirs want the home at all or not? Usually that answer is no, although there are times where the heirs do want the parent's home. But if they do not want the property and there's equity in the home, then they simply sell the home, they pay back the HECM balance, and the heirs are entitled to all and any remaining equity. If they want to keep the home, well, they have to have some way somehow to pay back the HECM. They can either do that by paying it off in full using other assets that they might have inherited, maybe life insurance proceeds, or if they don't wish to use their own money, they can go to their local bank and they can refinance mom and dad's HECM into a regular mortgage and keep the property and make payments by paying off the HECM through refinancing it into a conventional mortgage. But if there is no equity, again, the heirs have no liability, so usually the heirs would do something like a deed in lieu, where they would simply turn the keys back over to the lender and HUD, but they have no personal liability for any deficiency.
Got it. Okay. I'm gonna maybe ball up a couple of questions here and kind of give it all as one. Are there credit score requirements? And then you kind of like brushed very briefly over the income qualification stuff. Could you maybe expand on that just slightly and then address if there's credit score requirements?
Sure. So as Christina said, we do pull their credit, but we do not have a credit score requirement either. We're looking to make sure that they can meet all of their financial obligations. So because they're required to pay taxes and insurance, we also want to make sure that they can meet all of their financial obligations. So when we pull their credit report, we want to see, do they have a car payment? Do they have minimum payments on credit cards? Because again, we want to make sure that this is appropriate and they can meet all of their financial obligations. But again, no credit score requirement, and we do not have debt to income ratios either. But again, in the calculation of their responsibilities, we have to make sure that their documented income can meet all of their obligations. And then we also have a term now called residual income. So after accounting for all of their obligations and responsibilities, do they still have enough monthly money left over to, you know, eat, put gas in their car? We even have a monthly utility bill calculation. So we even build that into the things that they would need to maintain the property. But we don't have a strict debt to income ratio like you would with a conventional mortgage.
Got it. Any rules against purchasing a duplex or even like a 2 to 4 unit multifamily?
Christina, I'll let you answer that. I don't want to monopolize all the questions here, so I'll turn that one over to you. We're happy to answer it.
Sure. Yeah, thank you. No, that's actually a great way to structure it. As long as they're moving into one particular unit of that duplex or up to 4 unit, and that they're with a lender that will allow for it. There are a couple lenders who won't, but that is a great strategy to do, because then they're going to be able to get rental income from those other units.
Okay, cool. Yeah, awesome. That's always a good thing. And I don't know if, like, there's so many questions in here, you guys. Maybe just like, let's just hit on this one more time. I think we've already covered it a couple times, but it continues to come in, which is essentially, okay, we're at the end of this thing, and the home is worth less than right. There's no equity left, and they continue to live in it. Let's say, what happens there? Like, what happens once we get into that spot where there's kind of that influx and there's less equity than, like, I believe I'm
Sure.
hearing, like, who's responsible for that is essentially what Sandra's question is.
Sure. Yeah. So the FHA insurance, again, there are insurance fees that are built into the closing cost. So the FHA insurance is not free. There is an expense for that. But if the occasion occurs where the folks are living in the home and the home does become underwater, they still have every right to remain in that home. The loan does not become due just because the HECM has exceeded the value of the property. As long as they are living in that home, paying their taxes and insurance, and maintaining the property, even if the home is underwater, which again isn't very likely because they're putting so much equity down, but if that would happen, they can still live in that home. And when they pass away, any liability or any deficiency that's created by the home being worth less than the value of the property, that's what the FHA insurance premiums would pick up at the end, but that deficiency is not paid by the homeowner or their heirs or their estate. But the FHA insurance premiums would cover that.
Awesome. I'll just answer this one. Yes, this is being recorded. We've had 50 people ask that question. It's being recorded. We'll send it out to everybody about 24 hours from when we shut this thing down. So tomorrow around 11 a.m. Pacific time, you guys will get the recording delivered to you. Along with the recording, we'll have the PDFs that they had, the Home Builders Toolkit, the Realtor Toolkit. I'm not sure who to address this question to. Maybe this Christina, and I don't even know if you're going to have the answer, but I want to ask it because a lot of people have asked. This slide deck that you guys are using, would you guys be willing to, like, turn this into a PDF and allow us to have the slide deck along with the recording? I'm not sure why, but a lot of people are real interested in this slide deck.
Absolutely.
That's awesome. Okay, cool. So we'll have we'll take the slides, we'll turn them into a PDF, and we'll attach those to the recording. Noel, make a note of that we get out for you guys tomorrow. Wow, there's just a lot of questions here. I almost feel overwhelmed. I'll tell you what, you guys, this has been one of the best webinars we've done in many years here on Active Rain. Just the feedback has been awesome. The amount of engagement with people, the number of folks we had coming on here to kind of listen, the people that are still left here, like, a great audience. So thanks to you guys for taking some time out of your day to come and listen to these. This is what I'd like to do at this point. Let's say that, because there are a massive amount of questions here, and some of them are real specific. What if I'm somebody who, I get done with this webinar, Christina, and I'm like, I want to talk to somebody. Like, what would I do? Would I just go to that link we sent out and find a certified professional in my area and reach out to them? Or kind of give me what would that path be for somebody who's sitting here, they're sitting on their hands, and they're like, I want to talk to somebody about this right now?
Yes, absolutely. And I actually had a text from someone that said reversemortgage.org is actually a consumer site where you're going to be able to search for a certified professional and in your area and just call them up, email them. We're all very open and love answering questions because it is a very intricate product.
Cool. So reversemortgage.org, you guys can use that link that I had sent out earlier as well to find somebody from I'm going to mispronounce this now, but from the website that they were showing a little bit ago. Go back to that website slide for me, will you? Actually, you might be on that slide. Let's make sure yeah, there it is. normlaonline.org. So you guys can go there and find a professional. Christina, Chris, Scott, thank you guys. This was really awesome. Like I said, one of the most educational things that we've had for a while. And I think something that, you guys, a lot of these stories, or you hear real estate agents, right? Like it's almost become cliche, but the idea of like you get into this business to help people, and this is like a product that can actually help people. Like I feel like there's somebody on this call has probably, like Christina was mentioning, like has somebody in their Rolodex. Do people use those anymore? But has somebody in their Rolodex who's like, oh my goodness, this is perfect for these people that I talked to in the last year. And there was I didn't know of any options for them, but this gives them an option. So I mean, awesome stuff, you guys. I can't thank you enough for doing this today. I'd love to have you guys back in the future as well. Thanks.
Happy to do it.
Yes, thank you.
All right, you guys, get out there, take advantage of this. Reach out to a certified professional through the website. When you leave the webinar, a couple questions I'd love if you'd spend maybe 10 seconds answering. And wow, this is awesome stuff. It's actually when I'm only the moderator, and a lot of times I don't listen, but you guys had my full attention here today. I can't thank you enough. On behalf of Scott and Chris and Christina and the folks behind the scenes here from Normla, they helped set this thing up, so we appreciate the heck out of you guys. Noel's recording this. We'll send the recording out tomorrow. You guys have an awesome Tuesday in real estate. Have a great rest of your week. My name is Bob Stewart. Bye-bye, everybody. Christina, you guys.
Bye now. Thank you.
Thanks
Take
again.
care.
Bye, everybody.
Thank you.